Happy morning, people. So yeah, for a change, now we are having this class in Chennai due to our felicitation program. So we'll do a special standard today, that is Ind AS 36, called Impairment of Assets. I think when we did Ind AS 38, we did see about impairment loss recognition, right? So we had studied there that impairment loss will only come under one and only one circumstance. What is that circumstance? Only if the carrying amount, if it is greater than the recoverable amount, only in such case may impairment loss will come. In all other case may impairment loss will never occur, right? That's what we had studied in Ind AS 38, and we had booked impairment loss. I think in a couple of questions we had seen that. Now in this standard, we will discuss more about which assets are impaired, how to recognize impairment loss, how to measure them. So some extra points relating to impairment we're going to study in detail in Ind AS 36. Okay, that's the scope of the standard. Okay, first, the overview of the standard is, the intention or the background behind framing of the standard is, sir, it is impairment of assets. So first, liabilities are not impaired. So Ind AS 36 is only applicable for assets. Liabilities, Ind AS 36 does not apply. That is one. Okay. Because liabilities, most of the liabilities are financial instrument. There is another standard, Ind AS 109 and a couple of more. So that standard gives a comprehensive treatment. Hence, so liabilities are not impaired as per Ind AS 36. That is one. And so that means this particular standard applies only to assets. Okay. And the background behind the standard is, the assets should not be overstated in the financial statement. Asset ka value should not be shown more than what they actually are in the financial statement. That is the main intention or intent behind this particular standard. Okay, that is one. And we already know impairment loss will only come only in one and only one circumstance. What is that? Only if carrying amount, if it is greater than recoverable amount. This is as some main headers or overview of Ind AS 36. So far, okay? All right. Next is scope. So we know, by now we'll know that liabilities are not impaired, only assets are impaired. Now the next question will arise, which all assets will get impaired, sir? Non-current assets, current assets also, and all the non-current assets are, or which all, right? So that is what we are studying in the scope aspect. All right. So though the word says scope, if you here they've defined what are the exclusions, meaning for what assets Ind AS 36 is not applicable. So if for these assets Ind AS 36 is not applicable, means for the remaining assets Ind AS 36 will be applicable, like that, right? So first, if you have any current assets, could be a debtor, inventory, whatever, right? Prepaid expense, whatever, they are not impaired. So inventory, debtors, etc., are not impaired. Basically, all current assets, whatever current assets you have, you will not apply Ind AS 36 ka standard. That goes for inventories. Financial asset means debtors, cash, etc., We'll learn more about financial assets in Ind AS 109 topic after like maybe 4-5 days. Okay. So basically, in simple thumb rule, all the current assets are not impaired. That is one. If you have any deferred tax assets, we'll learn more about deferred tax assets in Ind AS 12. In Interme, we had accounting standard 22. There you might have studied DTA and DTL, deferred tax asset and deferred tax liability. They are not subject to impairment. That is one. And if you have any employee benefit assets, there are some assets which arises due to employee benefits. Okay. We call that as plan assets. If you remember AS 15, we have worked out problems there. This AS 15 was newly introduced into the inter syllabus. If you have not studied and not aware of it, no problem. We'll study the same in Ind AS 19. Okay. There are some assets which come due to your employee benefits. They are broadly known as plan assets, right? Such assets are also not accounted as per Ind AS 36 because Ind AS 19 gives a full comprehensive treatment for it. Since one standard is giving a clear treatment for it, Ind AS 36 has taken a back seat. So Ind AS 36 is not applicable for this asset. And also any asset measured at fair value. Any assets measured at fair value, like biological assets or any non-current assets held for sale. Both these assets, right, biological asset and non-current assets held for sale, both are measured as at fair value. So for both, Ind AS 36 is not applicable because for biological asset, comprehensive treatment is given by Ind AS 41. For non-current assets which are held for sale purpose, not yet sold, but we are planning to sell, for that Ind AS 105 will get triggered. since there are other standard which gives comprehensive treatment, Ind AS 36 is not applicable for all of them. Fine now, people. That means what remains, sir? So if you have to really say, Ind AS 36 basically applies for your PP. Just 1 second. Oh, I think I'm not able to. Okay, no issues. 1 minute. For PP, oh, there's some weird thing over here in this. All right. So PP, intangible asset, investment property. So for basically for these assets, you could say Ind AS 36 impairment is applicable. That's all in simple terminology. Okay, now people, everybody cool so far? So basically PPs, intangible assets, investment property. For these, you'll apply Ind AS 36 impairment concept. For all other assets, mostly it will be excluded because there are some other standards which talks about them. Done. Can I move forward, people? Everybody so far good? Are on the same page? Today we are hosting full online mode, so I need more response from you, especially early morning. All good? Can I move forward? Hello, hi. Move forward. Okay. Give a response, people, so that it'll be easy for me, so that I know that there is no technical issue because we have changed the location now to Chennai. No, so I just want to know that there's no technical error. So everyone, okay? Yeah, finally I'm getting a response, so it's good. So I'll move forward. Okay, thank you for that. So moving on to the next assets. Now people, we already know that impairment loss will only come under one circumstance. What is that one circumstance? Only if carrying amount, if it is greater than recoverable amount, not in any other circumstance. That is one. Okay. Now, to find impairment loss, we need carrying amount as well as we need recoverable amount. We need both. We compare the two. Only if carrying amount, if it is greater than recoverable amount, we book something called impairment loss, right? In fact, we had studied this also. RA. There are two ways to recover from an asset. Do you remember what are those? If you have an asset, there are two ways from which you can recover from that asset. One by using, another by selling. One by using, another by selling. So that means sale value is nothing but your market value. Correct? No, because when we want to sell an asset, obviously we want to sell it at market value. Correct? So basically recoverable amount is nothing but your market value or value by using the asset, whichever is higher. That we had, I think we had studied that in Ind AS 38, correct? More about that also we'll discuss now, but just saying, since recoverable amount considers fair value or market value, one of the components to find recoverable amount is fair value or market value. Now you think, will the market value or fair value of any asset be same every day? Obviously no. If PPE ka market value is 10 lakh today, tomorrow it can be 10.2 lakh. Maybe after 1 month it can be 10.5 lakhs possible. So the market value may change daily. That means daily we will check impairment loss. Daily we will find recoverable amount, compare it with carrying amount and find impairment loss. Is it practically possible? And first of all, moreover, do we have one asset or we may have hundreds and thousands of assets? Big company will have hundreds and thousands of assets. So we can't keep finding market value for every PPs and intangible assets on a daily basis. So it's not practically possible, correct? Hence, that means when do you do an impairment check? When should we do it? Year beginning, end of every month, end of every quarter, end of every year? That question arose. When should we apply this standard? On a monthly basis, quarterly basis, or yearly basis, or when? For that, Ind AS 36 says, you need to do impairment check. We need to do impairment check only if impairment indicator comes. On the day impairment indicator comes, on that day you will do impairment check. So it is not year beginning. It is not monthly activity or quarterly or yearly activity. It is a indicator wala activity. The moment indicator comes, that day you will find out recoverable amount, compare it with carrying amount and book impairment loss if necessary. So it's entirely driven by what? Indicators. Understood this? So far good. So you don't have to do it as a timely based activity. It is basically an indicator based activity. We'll talk about indicator in a bit. But there are three assets. There are three assets which Ind AS 36 says whether indicator comes or indicator does not come. For all other assets, you will do impairment check only if indicator arises. If impairment indicator comes, then only you will do the impairment check. But there are three assets. For them, whether indicator comes or it does not come, at least once you need to do an impairment check every year. Only for three assets. Okay? Only for these three assets, we need to do an impairment check at least annually once, yearly once. So what are those assets? Goodwill, which arises as part of business combination. You remember in one of our previous problem and all we have checked, when PC is greater than we compared with net assets. Balancing figure, we used to call it as goodwill. That goodwill is accounted as per Ind AS 103. So if you have goodwill that you have got as per Ind AS 103, on goodwill, you need to do an impairment check at least once. That is one asset. Second one, intangible asset with unlimited useful life. In Ind AS 38, we saw there are some landing rights, broadcasting rights, which can have unlimited useful life. Do you remember that question? So if any intangible asset has unlimited useful life, for them, you need to do the impairment check at least once a year, even if indicator is not there. And another one is intangible asset, which is not yet available for use, meaning development phase. Intangible assets under development, do you remember? Development phase expenditure we used to capitalize if TIFRC is satisfied, right? And show it as intangible asset under development. So this intangible asset under development, on this also you will check the impairment at least once. Only for these three, you will check the impairment once a year. For all other PPEs and intangible assets and investment property, you will check the impairment only if indicator comes into picture. That is the day you need to do this activity. Is this portion clear for everybody? So far good? Can I move on to the next? This is a very numerical topic, people, but in order to solve the numerical questions, there are some good numerical questions from this topic, but in order to solve that, we need to be comfortable with a few provisions. So another 15-20 minutes or so, we will discuss the provision, then get to the numerical questions. But so far, are we okay? No issues, right? Any doubts anybody is having? Online, offline? Offline, nothing today. So all online today. Yeah. Yeah. So they're saying yes. So I'm thinking you're speaking for everybody and I'll move forward. Okay. All right. Moving on to the next. Now we again learned the takeaway from the previous thing was impairment check is only done if indicator arises for all assets. Other than these three assets, all other assets ka impairment is done only if impairment indicator comes. Now, what is this indicator, sir? Ind AS 36 says indicators are of two types, external, internal. Indicators are of two types, external indicator, internal indicator. Okay, you can have an external indicator or internal indicator, it does not matter. If any of those have come, then you will do the impairment check. So what are external indicators, sir? External indicator means those factors which are outside the entity influence. It is outside our company ka influence, like decrease in the market value of the asset. Let's say building, we purchased a building for 50 lakh, its market value has become 25 lakh. So decrease in the market value of any asset is an external impairment indicator. So if market value of an asset has decreased, then we say it's an external impairment indicator. So due to this, you need to do an impairment check like that. Now due to COVID, right? So many assets ka value reduced, if you remember, right? So that COVID was a external impairment indicator. That like that. Okay, Sarji, this is one. Another one is, let's say there is an unfavorable changes in the technology or law. We were using a particular software or a patent. Now let's say due to the recent technology, our existing patent has become outdated. Like due to AI, so many softwares are getting outdated, correct or no? Now, if you remember earlier, now everybody is using smartphones, but go back 10 years back, everybody used to use that touchpad wala phone, correct? Nokia used to be a big player in the touch phone market, if you remember. Yes. Now, Nokia, when they had introduced that dial pad wala phone, correct? They would have filed patent over it, correct? No, they would have taken patent rights over it. Now, do you think that patent has any value in today's environment or it's outdated? Outdated, because now majority of the population uses the smartphone. Touch the keypad wala phone or the dial pad wala phone, hardly anybody uses, right? That is what? a unfavorable change in the technology. So new technology has come, so the existing technology has become outdated. So if you have any patent or software related to our old technology, then that is probably not worth so much anymore. So that's your external, one of the examples of external impairment indicator. Okay, sir. Or it could be unfavorable law change also. Now recently, if you know, remember, I think 5 years or 6 years back, I think government made a change. Some plastic they banned, if you remember. Certain microns of plastic, if you remember, I don't know whether you remember this or not, right, were banned. So if a plastic bag has a certain micron level, it is acceptable for usage. If it's below certain micron level, government told you cannot use it because it's not getting biodegraded, right? We're not able to like decompose it. So hence, considering the economic environment or environmental impact, they banned it. So that is your unfavorable law change. So if a government bans you from using a particular asset or restricts you from using the asset fully, all that is an unfavorable law change, which is considered as an external impairment indicator. So when all this comes, you need to do an impairment check. Sir, I'm using the word do impairment check. I'm not asking you to book impairment loss. When these indicators come, you only do the check. And how do you check? By finding recoverable amount. And then compare it with the carrying amount. And if at all, if carrying amount is greater than recoverable amount, then only you will book impairment loss. Got it, Asarji? Okay. If there is any increase in discount factor, I'll tell you what this is. In problems, we will say, right? If discount factor increases, that is also an external impairment indicator. Sir, when we say indicators, right? These are just for sake of example. These are not full list. These are some of the examples. You could have more external indicators also. These are just for explanation purpose. We have written it out there. Indicators means that these are just some of the parameters. There could be a few more also. But for our discussion, I think this example is good enough. Next are some internal impairment indicator. B part, unfavorable technology, macha. Unfavorable technology, like old technology. We have a patent, right? But that patent relates to old technology. But that old technology has become outdated now. A new technology has come. So if a new technology has come, our existing patent and software, we cannot use it fully. We cannot use it to that extent as we were using before, correct? So hence, if you are not getting the same benefit from that asset as before, that is also an external impairment indicator. Okay, Igneshwar, got it, huh? Basically, sad scenario, not happy face wala scenario, sad face wala scenario. Okay, clear? Can I move on to the next? Okay, great. All right, next is some internal impairment indicator. Internal means within the entity factors. Like previously, I think I told you an example, right? Josh may, if my iPad falls off, right? Josh may while taking class, if my iPad falls off and gets damaged, right? Before damage, maybe I could use my iPad 10 hours a day. But because it has fallen and got damaged, now if I feel I can use it only for 8 hours a day, right? That physical damage caused to an asset due to fall or due to whatever reason, that is an internal impairment indicator. So if any asset has got damaged, that's in one of the impairment indicator. Okay, that is one. Second one, if there is any change in the usage pattern, like let's say earlier I used to use the iPad for 12 hours a day. Earlier, to conduct the classes, we used to use the iPad 12 hours a day. Now we are using it for only 3 hours. Now you tell me, does it look like a good case or a bad case? Is this scenario looking according to you good or bad? Sir, earlier I used to use it for 12 hours, means I used to get more benefit from the asset. Now I'm using it only for 3 hours. That means something has gone wrong. Do you agree with me? From 12 hours, if I'm using it only for 6 hours or 3 hours, that means something has gone wrong with this asset. So only I have reduced it. So if that usage pattern has changed, meaning if there is any reduction in the usage of any asset, that is also an internal impairment indicator. These are not that important for examination, people, just discussing for our knowledge sake. So these are very less chance of all this coming in your examination, because all this they have to give it as a theory or as a case study. So far we have not seen these and all turn up in examination. That much I can say. Done, Sarji. So you got a fair idea about indicator now? Okay. All right. Okay, let's do a thing. Since all these terminologies are new, let's have one quick recap of what we have learned and then move forward. The standard name is Ind AS 36, which talks about impairment of assets. First point, liabilities, whether it is current liability or non-current liability, does not matter. Liabilities are not impaired. Point number one. Second one, what is the basis of the standard? The overview or the overall of this particular topic is to make sure that the asset is not overstated in your balance sheet. Asset is not shown at a higher value than its correct value in the balance sheet or financial statement. That's the scope of this particular standard. And then this particular standard accounts impairment loss, and impairment loss only will come under one circumstance, one and only one. What is that? Carrying amount is greater than recoverable amount. Fine, that is one. All right. So basically, which assets are impaired? Your PPEs, intangible assets, and investment property. Your current assets, employee benefit assets, deferred tax assets, biological assets, non-current assets held for sale, all these are not impaired. Okay, fair enough. That is one. Next one. Sir, when should we do the impairment check? Is it a time-based activity like a monthly, weekly, quarterly, yearly? No. It is based on indicator. Whenever indicator comes, if indicator comes on the first day of the year, you do the impairment check on the first day. If indicator comes on the 400 or on the 100th day in the current year, on the 100th day, you will do the impairment check like that. The day the indicator comes, that day you will do the impairment check. And to do the impairment check, we need carrying amount and we need recoverable amount. That is one. But there are three assets. Whether indicator comes or whether it does not come, we have to do the impairment check on those three assets at least once a year. They are goodwill, which comes as part of business combination, intangible assets with unlimited useful life, intangible assets which are under development. Only for these three. For all other assets, you will do the impairment check only if indicator arises. And indicators are of two types. They are external indicator, internal indicator. External indicator ka some of the example could be adverse changes or unfavorable changes in the law or technology, decline in the market value of the asset, increase in the discount factor. Increase in the discount factor, don't worry about this. In the problems, if you want, I'll tell. That's okay. An internal indicator. Internal indicator could be physical damage caused to the asset or changes in the usage pattern. Change in the usage pattern means usage hours you are reducing. Or if you are using the asset for a lesser duration, that is also an internal impairment indicator. Okay, an indicator means you could have more, like loss of key managerial person is also an impairment indicator. Okay, like this you can, if the entity is continuously making losses, that also could be taken as an impairment indicator. So there could be more indicators. We have just listed out this just to understand what does this indicator mean. So far, that's what we have studied. Okay. With your permission, can we get to the next part? There are maybe you could say 3 or 4 small concepts. Then probably we are, I think, good to dive into the numericals. But one good thing is, those of you who cleared your CA intermediate income, till now we have not studied anything new. All this, in fact, if you remember, same examples, same things I used to tell in CA intermediate also, right? So it's nothing much new as such. But any which way, I thought some of you would have not covered the standard. So I'm just thinking that we are learning it for the first time and that's how we are approaching. By the way, how many of you learned the standard as AS 28? AS 28 and CA Inter talked about impairment of assets. How many of you studied, when you wrote your examination, AS 28 was applicable? How many of you? Show of hands. Okay, so few of you have done, and others who are not responding. That means I'm thinking that you guys you're learning this for the first time. Okay, fair enough. Okay, fair enough. Okay, got it. Okay, haven't studied, no problem. Jayan, so far good, no? Even if you're studying for the first time, so far all comfortable, right? No problem. So with your permission, can I move on? Okay, perfect. Thank you. All right, next one is recoverable amount. Sir, we already know. As the name itself is saying, recoverable amount. There are two ways through which you can recover from any asset. If you have invested any money to buy an iPad, AC, furniture, laptop, whatever, there are two ways through which you can recover from any asset. One by using, another by selling. The benefit that you get from using the asset, we call it as VIU, as in value in use. Value in use. The benefit that you get by selling the asset, we call it as fair value. In fact, we don't take the fair value, we take net benefit. Because sometimes in order to sell the asset, we'll also have to incur some selling expense. So we need the net benefit. Hence, we don't take fair value, we take fair value less cost to sell. Because this is the net number or net benefit we'll get by selling the asset. Fair value less cost to sell. This is one portion of recoverable amount. And by using how much benefit you will get. By using how much benefit you will get, we call it as value in use. For class purpose, we'll call it as VIU. Compare these two. Whichever number is higher, that becomes your recoverable amount. So basically, recoverable amount is fair value less cost to sell or value in use, whichever is higher. As simple as that. Okay, and this is how to find out the recoverable amount. Okay, moving on to the next thing. Now people, this one small concept too. Circumstance in which it is not necessary to calculate both fair value less cost to sell and value in use. What are they trying to say? Recoverable amount is higher of two things, no? Fair value less cost to sell or value in use, whichever is higher. So this is trying to say, in what circumstance both you need not find, one is good enough. Meaning, fair value less cost to sell and value in use, both you need not find, only one is good enough. Under which circumstance that will arise? Common sense really. Check. I've just given an example. They've expressed in words. I've just trying to express in numbers. Suppose a carrying amount of a particular asset, PP, is 50 lakh. Okay. Value in use is 60 lakh. Value in use is 60 lakh. Assumption. Now you tell me, fair value less cost to sell, required or not required? Use your common sense and tell me. If I give you these two information, is fair value less cost to sell really required to be found out or not required? Not required. Why? Why is it not required? So recoverable amount is higher of two things. Fair value less cost to sell or value in use, whichever is higher. Even if fair value less cost to sell is 0. Even if fair value less cost to sell is 0. Since value in use is 60 lakh. Since value in use is 60 lakh. Recoverable amount is higher of two things. No? Even if the fair value less cost to sell is 0, RA will be still what? RA will still be 60 lakh only. Got it? That is one. And what is the carrying amount? What is the carrying amount? 50 lakh. Carrying amount is 50 lakh. Correct? Since is carrying amount greater than recoverable amount? No. We are showing the asset at 50 lakh, but we can recover 60 means impairment loss is there or it is not there. Impairment loss is not there. That means the moment these two data is given, I know that impairment loss is not there. So hence, the other component, fair value less cost to sell, in this case, not even required. Because in this case, we know that recoverable amount is minimum 60 lakh. Even if fair value less cost to sell is 0, recoverable amount will be 60 lakh. If fair value less cost to sell is 80 lakh, then recoverable amount will become 80 lakh. But we know for sure that in this case, impairment loss can never arise. Because you are showing the asset at 50, you can recover at least 60. So asset is not overstated. So impairment loss will not come. So in this circumstance, fair value less cost to sell is not required to be found out because there is no impairment loss. Basically pure common sense. Okay. Again, now that may not be that important for examination. Next point is fair value less cost to sell. So fair value means what? Market value. Cost to sell means selling expense. But keep in mind, this is a pre-tax activity. This impairment loss is a before tax wala activity. So your income tax expense is not considered as a selling expense. If you made any provision for tax in your books and all, it will not be considered as cost of disposal or cost to sell. And if you have any finance cost, it is not considered as a selling expense. Like if you have taken a loan, right, on a building. Now, if you want to sell a building, on that loan, you might be paying some interest and all. No, that interest is not considered as a selling expense. Obviously, no, interest is not your selling expense. Correct? So that's what they're trying to call out over here. Selling expense will exclude your income tax provisions and your finance cost, if any. So by chance, if they give you finance cost and all, it should not be considered for fair value less cost to sell wala calculation. That's all this para is trying to say. Done, Ji. Again, this you don't have to mug it up. Just read it once to know that all this, if at all they bring it in the adjustment, you should know that they should not be considered for fair value less cost to sell ka calculation. That much is. So theoretically, you'll not very doubtful that they'll ask, explain fair value less cost to sell. Such questions, straightforward theory questions and all, very rare in the FR paper. Okay. All this may be applied in the numerical questions. They might give you some finance cost in a numerical question. So you need to know that they should be excluded for fair value less cost to sell wala calculations. That much is good enough. Okay, next one is, sir, is there any priority for fair value? Yes, Ind AS 36 says there is a certain priority to find fair value less cost to sell, or preference. First preference for fair value less cost to sell or fair value is always given to the binding sale agreement value. First priority is given for binding sale agreement value. Meaning, let's say I have made an agreement. I am A Limited. I have made an agreement with B Limited saying I will sell my building PP for 50 lakh rupees. I will sell the building. A Limited has made an agreement with B Limited saying that they will sell the building for 50 lakh. Okay, correct? So such agreement is already done. So that agreement value in my example is 50 lakh. That 50 lakh itself will be taken as fair value less cost to sell. So first priority for fair value less cost to sell is binding sale agreement. If you already have an agreement to sell the asset, that agreement ka value itself becomes fair value less cost to sell. First priority. Okay. If such an agreement is not there, then try to find fair value less cost to sell from the active market. Active market means a market where there are large number of buyers and sellers. Okay. Now your Sensex, right? Your BSC, NSE. So they are active markets. Now, if you know, there is a Chennai Stock Exchange also, Bangalore Stock Exchange also. That is an inactive market. In Bombay Stock Exchange, National Stock Exchange, there are large number of buyers and sellers. So it is an active market. Inactive market means where there are no large number of buyers and sellers. Like that. Understood? Okay, so try to find out fair value from the active market. Meaning if you sell an asset in active market, how much money you will get. That becomes your fair value. And if there is any selling expense, reduce that. Okay. If binding sale agreement value is missing, then the second priority is we try to find out the fair value from the active market. But even if you say active market is also not there, because you could have some intangible asset, no? Some intangible asset, especially internally generated software, internally developed software and all. For if your company itself has found out some asset, means they may not have active market. There could be a possibility, correct? Because nobody else is using that software. You only developed it and only you are using it. So there is a possibility that such an asset may not have an active market. So if active market, if it is missing, then third priority to find fair value less cost to sell is based on best information from the management perspective. So management has to use their best information available, their judgments and information available, and try to find out the fair value. I mean, according to their assessment, if they sell the software, how much money can they expect to receive? So that becomes your fair value. And that's your third preference. Keep in mind, you have to follow the same order. First priority is the sale agreement value. If that is missing, try to find out fair value from the active market. Active market also missing, try to find out the fair value using the best information possible along with the management judgment. If this also cannot be found out, if management, none of these are there, management also says we don't know, this is an entirely new asset, there is no active market, and we also don't have enough information to find out fair value. If all the above three are not there, then what standard says is ignore fair value. If all the three are not available, means ignore fair value, take value in use itself as recoverable amount. Ignore the fair value, take value in use itself as recoverable amount for impairment loss calculation. That's your order or priority for taking the fair value less cost to sell. Again, for examination per se, not that very important. Just theoretically there, so we're just quickly covering it. Done, Asarji. This is about fair value less cost to sell. But we know that recoverable amount is higher of two things. What are those two things? Fair value less cost to sell or value in use, whichever is higher. Now we've had a discussion around fair value less cost to sell. The next discussion will be in value in use. So what about value in use? For class purpose, we are calling value in use as VIU. Just a minute. Excuse me. Okay. So value in use, how do you get? In simple language, in common language, what does value in use mean? Value in use means by using the asset, how much benefit the company can expect to receive. By using the asset, how much benefit can the entity expect to receive? That only we're calling it as fancy term, value in use, or in simple terminology, VIU. Okay. Now, here there is a small issue. What is that issue? Sir, suppose if impairment indicator comes today, then you have to find value in use today only. Because on the day impairment indicator comes, that day you need to find carrying amount and recoverable amount, compare, and then book impairment loss if necessary. And to find recoverable amount, we need fair value less cost to sell as well as value in use. So if impairment indicator comes today, we have to find value in use also today. But all the benefit from the asset you will get today only. If I have an iPad, now I have this iPad. All the benefits from the iPad I will get today only, or it's in the future? Future. If I'm planning to use the iPad for 5 years, that means from this iPad I will get the benefit for 5 years. Correct? That means all these benefits are not on present value terminology. They are on future value terminology. But we are doing the impairment check today. So we need a value in use today. Hence what? Value in use is nothing but the present value of the future cash flows that you are expecting to receive from that asset. Basically, benefits will be expressed on future value terminology. Use the discount factor and get it on the present value terminology. That's all it is. Okay. They will give you in the question that from this asset, these are the benefits that we are expected. The future cash flows expected from this asset are like this. That will be given to you in the question. You don't have to worry about this. And this you take, future cash flow you take, multiply by the discount factor, you will get the present value. That is one component. Now people, if you are planning to use the asset, in my example I told, we are planning to use the asset for 5 years, right? After 5 years, what will happen? Will we keep the asset or we will sell it? Sell it. That only we call it as what? Residual value. This is also benefit, correct? No? Once we are satisfied with all the usage, once we feel we have utilized the asset fully, then at the end of useful life, we will sell it. That only we call it as salvage value, scrap value, or residual value. That is also a benefit. Now this benefit when you will get? In my example, residual value you will get at the end of 5th year. So residual value is not present value, it is a future value. So this is also benefit, right? So find out the present value of the residual value or scrap value also. So by adding these two, you will get value in use. Okay, both the data will be given to you in the question. By using the asset, how much benefit you will get, cash flows, that will also be in future value terminology. So get them on present value platform. At the end of useful life, 5 years, 10 years or whenever, right, you will sell the asset, right? That is also a benefit. Even that benefit is expressed on a future value terminology. So get them on a present value terminology. So if you add these two, that number only we call it as value in use. That's it. Just waiting, thinking you need some time for processing. Fair enough. So I'm not hearing any comment. So I'm thinking you guys are good. Okay. All right. So I shall. Okay, 1 minute. Get some commento. What is a commento? Okay. Done. Fine. Fair enough. Thank you, people. So let's move on. Now, people, when you're finding value in use, like when you found out the fair value less cost to sell, I told a few things should be excluded, like income tax. If you have any provision for income tax, it is not your selling expense. Finance cost is not your selling expense. There were some exclusions. Similarly, when you're finding value in use also, because we have to estimate future cash flows, no? Correct? That future cash flows only we multiply discount factor and get present value. So when you are estimating future cash flows, few things should be excluded. When we are estimating some future cash flows, few things to be excluded. 1, future asset ka enhancement cost and enhancement benefit. What did I say? This asset ka future, if you are doing an impairment check for a particular asset, let's say building, right? That building ka future enhancement cost and future enhancement benefit, both should be ignored. Sir, did not understand, sir. Like here, let us say we have a factory. I written this example, so I'll just continue with this. Let's say we have a factory and we are doing an impairment check for this factory because some indicator has come. Maybe market value of the factory has reduced. So that's an external impairment indicator. So we are doing an impairment check. So to do the impairment check, we need recoverable amount. And recoverable amount is higher of two things: value in use and fair value less cost to sell. Correct? Now, let's say currently my factory can produce 1 lakh units. From factory, I have a capacity to produce 1 lakh units of a finished product. That's a current capacity. But in future, I have expansion plans. After 2 years, I have an expansion plan. I want to expand my capacity. From 1 lakh, I want to expand this factory such that it can produce 5 lakh units of finished goods. Current capacity is only 1 lakh. After 2 years, I want to expand this factory so that it can produce 5 lakh units. This is your, now you tell me, 1 lakh ka benefit and 5 lakh ka benefit is same. Your current benefit and this 1 lakh ka benefit, 5 lakh ka benefit same? No. If you sell 1 lakh units, benefit may be 1 crore. If you're selling 5 lakh unit, benefit may be 5 crore. Correct or no? So this is your future enhancement benefit. That is excluded for your cash flow calculation. Okay. And to do this enhancement, to expand this factory, we'll have to incur some cost also. That we call it as future asset ka enhancement cost. Both the benefit as well as cost are ignored for value in use calculation. So why, sir? Because we are doing impairment check on the asset condition as it is. The way the asset it is currently, in whatever condition the way asset is currently, on that condition we are doing impairment check. Now if you do the enhancement, if you do this improvement, asset ka condition will change, no? So we are not doing the impairment check on the new asset. The way the asset is currently, in the same condition, we want to do the impairment check. Hence, all this future enhancement cost and enhancement benefit, all that is ignored for value in use wala calculation. Because they will give it to you in the question. If they give it, make sure that you exclude it. That's all. Simple. Okay, sir. Next one. As I said, impairment is an pre-tax activity, meaning before tax activity. So if you have any income tax payments or income tax receipts, that is also cash flow, no? If you pay any income tax to the government, it's a cash outflow. If you receive any refund of income tax, it's an inflow, right? So that income tax ka payment as well as receipt, both are ignored for value in use calculation because this is a before tax wala activity. Because income tax you pay on the overall business. Income tax that you pay is related to overall business, but we are doing impairment check for a specific asset. So hence impairment check, since it relates to whole business, we exclude that for your value in use or cash flow wala calculation. So these two, I hope this is okay with you, right? Similarly, if they have any uncommitted future restructuring cost, restructuring means some changes, right? Now if you just check restructuring, normally we see, change in the management structure. All this the company will do. They will lay off the existing management, bring in new management, lay off particular employees, fire employees and all. All that we call it as restructuring. I'm sure you would have learned it in AS 29. Same thing will come in Ind AS 37 here. Just say. So if you have any uncommitted future restructuring cost, now whenever restructure happens, right, the old management and certain non-performing employees will be fired. You may decide to buy some new assets, invest in new technology or new assets. So that restructuring will always come with certain cost. So that uncommitted future restructuring cost is ignored because restructuring is again related to the overall business, not specifically related to any specific asset. Impairment is a specific asset related activity. Restructuring is overall business related activity. So there is a mismatch. Hence, if there is any restructuring cost, that cash inflow or for that matter cash outflow is not considered for value in use wala calculation. Uncommitted means the entity is not yet finalized. It is just in the planning stage. Okay. So such things are excluded from value in use calculation. And you don't have to break your head too much. All this will be straight away mentioned to you in the question. If at all they test, it's not really that big an adjustment for examination according to me. But if they give it all this, you just need to exclude them and do your value in use calculation. As simple as that. That's all about value in use. Any doubts so far, people? If you are good with this, we can start with the numericals. This much theory I think is good enough for us. Yeah. Need some more time of processing or can we move forward to our numericals? So silence, Mauna. So I'll take Mauna to be got it, not Tirupati toss, no. Not bouncer, no. So I think I can move on, no. Okay. Yes, we can move forward. Super duper. This one, remind me, people. Foreign currency future cash flows. This concept, remind me. I don't know if possible, if time permits, today we will take up this. Otherwise, tomorrow we will do it. In case I forget this, you just let me know. I think there is a question on this also. So I think we will not be forgetting it. But anyways, you also try to remind me on that. I'll take this up a little bit later. Let's do some basic questions and get a little more comfortable. Then we'll come back to this. Okay, now look at this question. Now people, this chapter has some questions, like I think, I don't know, some 15-20 questions maybe there. I've numbered them. Okay, I'll tell you before I start. If I write here number 1, okay, that means this is the question, or try to revise or try to study this topic or try to solve the numerical questions in this order. All these are ICAI study material questions only, but ICAI has mumbled and jumbled the order. The order is not very, like, in the way we are learning the concept in the same order, the questions are not there. Since I've taken these questions from study material, I've tried to maintain study material order. Like, yeah. So, but now we want to solve the questions in the way we are learning the concept. So when I say number 1, this is the first question we are solving in this. Like, next I will number them. Like here, if you just check, next question I would have numbered here. 1 minute, I'll just show you. This is like question number 5 in our class notes, but we will do it as a 12th question. Not now, like this. So try to study or revise in this particular order. So for big topics like consolidation, in fact, for many of the bigger topics, I've done this numbering approach. You can number them, put the same numbers in your notes, so that you'll know that this is the order in which you need to study or revise. Okay, that's the numbering significance. Okay, now come back. So let's take up question number 1. Easy question. Keep your calculator. Question number 1. That's what I marked it as 1 over here. So is that LDR? Not really, you could say, we don't have too many big concepts to learn from this question, but just it gives a good summary about a few concepts. So for that, I've made this question as an LDR. LDR, you already know what it means. Last day revision questions. So Mars Limited has given the following estimate of cash flows. Sir, they have given cash flow estimate. We need cash flow estimate for what? Value in use wala calculation, correct? No, that means in this problem, value in use will not be given. We need to find it out. That's our intention. Okay. So now following estimate of cash flows relating to PP they have given on 31st March 20x4. Keep in mind the dates, okay? Because impairment, you do it on a specific date, okay? We need the carrying amount. To do impairment check, we need carrying amount and recoverable amount. We need the carrying amount on the day impairment indicator comes. We need a recoverable amount on the day impairment indicator comes. On the day impairment indicator comes, on that day only we need carrying amount, and we need to compare it with that day recoverable amount and book the impairment loss. Hence, dates are important. Whenever you see the dates, try to underline in your notebooks. So this is 31st March 20x4. Okay. Discount factor is 15%. Why? Why do we need this discount factor? Because they have given the future cash flows. So all these cash flows are on future value platform. But we are doing the impairment check today, correct? So hence we need the present value of future cash flows. To find present value, we need discount factor, and that's given to be 15%. So they have given, currently we are on 31st March 20x4. We are on that date. So they will give you future year's cash flow, means current year is ending on 31st March 20x4, means next year will be x4, x5. Next 5, 6, 7, like this. They have given you 5 years ka, next 5 years ka future cash flows. All the numbers are in lakhs. Next 5 years ka future cash flows they have given. All these are future cash flows. Multiply by the discount factor. You will get the present value of future cash flow. Yes, no? But don't forget, what is value in use? It is nothing but your present value of future cash flows, present value of future benefit, plus also present value of residual value. Don't forget, many students will forget to consider the residual value. That is also a benefit, correct? So residual value is given, residual value when you will get? On the day you planning to sell the asset, meaning the end of useful life. Here you are planning to, if they are saying benefit, you will get it till 31st March 20x9. That means 31st March 20x9 is the useful life ka ending date. So residual value will be, you will get it on 31st March 20x9 in this question. How much is that? 500. That's all. Okay, people. That means, can I say last year benefit is 2,500? Do you agree with me? Last year, by using the asset, you will get 2000. At the end of last year, you will also sell the asset at a residual value of 500. So last year, the total benefit is 2500. If you want, you can calculate these two separately or club them and calculate. Correct? So this is your future cash flows. Multiply by the discount factor. You will get value in use. Check, that's what they've done. These cash flows from here to here, they would have copy pasted. Working note number 1 is value in use calculation. This is very simple. Okay. This cash flows is copy pasted from the question only. Last year, they've not taken 2000. They've taken 2000 plus residual value. If you want, you can consider separately. That's your presentation. It's fine. ICAI has taken these two by adding. So 2500 is your 5th year ka cash flow. Future cash flows. Multiply discount factor. Discount factor is given in the question to be 15%. This is easy, no? So future cash flows multiply by the discount factor, you will get the present value. So this number only, the total present value of that cash flow only becomes your value in use. This was not straight away given. We have to find out. That's all. Any problem in this number? No. Clear? Okay, move forward. Now check, read the other thing. PP was purchased on 1st April 20X1. You purchased it on X1. Currently, we are on 1st April 20X1 or 31st March 20X4. Our current date is 31st March 20X1. But PP you purchased on 1st April 20X1. So how many years? From 1st April 20X1 to 31st March 20X4, if you count, that's about 3 years. X2, X3, X4, 3 years has passed. Correct? No, so that means this is your original cost. So they have given original cost is 20,000. So when you bought the PP, life was 8 years. Residual value, we already know it's given here only, is 500. Sir, we need carrying amount on 1st April. No, we need the carrying amount and recoverable amount on the day impairment indicator comes. In bigger question of people, they will not give you impairment indicator date. That it has come on. Some problems may they will specify. Some may you will not see. So here if you just check, it is not given. But they told that estimate of cash flow we are doing on 31st March X4. Sir, when will you estimate future cash flows? Sir, estimation of future cash flows means finding value in use. You are doing that estimate on 31st March 20X4 means indirectly what is the question trying to say? 31st March 20X4 is a date on which indicator has come. So don't write a note in question saying impairment indicator data is not given. So I am assuming indicator has not come. So I will not calculate impairment loss and all. So don't do that. Okay. So in some cases, impairment indicator will be mentioned. Some may it will not be mentioned. But the moment they say we are estimating the cash flow on a particular date, that date only becomes your impairment indicator ka date. Okay. So this is your impairment indicator date. Meaning on this day, we need to find carrying amount and recoverable amount. So you need carrying amount on 31st March 20X4. But they have given the carrying amount on 1st April 20X1. So how many years is that? From here to here, the difference is 3 years. So original cost is 20,000. We need to simply reduce 3 years ka depreciation. That is very simple. No? So original cost 20,000. Depreciation. Carrying amount. Because the first time when you buy the asset, original cost, carrying amount same. 20,000 minus residual value 500 divided by useful life. When you bought the asset, life was 8 years. So from here to here, how many years has passed? 3 years. So this divided by 8 will give you, this will give you 1 year ka depreciation. Multiply by 3, you will get 3 years ka depreciation. So reduce 3 years ka depreciation and you will get the carrying amount. That's all. That's just very faltu, simple calculation. So carrying amount on 31st March 20X4 we have received. This is your working note. Okay, people. Carrying amount, recoverable amount. First, you'll have to get it as a working note. Then present a statement for impairment loss. That's what we'll be doing in all the questions over here. So working note number 1 is carrying amount. You can present in any working note. Like value in use can be working note number 1. Or fair value less cost to sell can be working note number 1. That is your call. Okay, how you want to present. But do present them as a working note. And then present impairment loss calculation as a statement or as a main answer. So carrying amount done. Working note number 1. Value in use done. Working note number 2. Any problem in these two? Anybody? I feel these are very, very simple. I feel, but are you also comfortable? Feeling fine so far? Can I get to working note number 3? Okay. What is working note number 3? So recoverable amount is higher of 2 things. Value in use or fair value less cost to sell, whichever is higher. So next working note will be fair value less cost to sell. But should we have to find it? No, fair value less cost of disposal or cost to sell, they only given in the question. This is given 10,000. So can you tell me what is the recoverable amount? That circle number is a clue for you. What is recoverable amount? Type it out for me. In this case, let's see. What is recoverable amount? Fair value less cost to sell is 10,000. All numbers are in lakhs. Value in use is 9510. So what is recoverable amount? The higher of the two, right? Value in use 9510 or fair value less cost to sell, whichever is higher. 10,000 or 9510, whichever is higher. 10,000 is higher. So recoverable amount, write these two. Higher of the two is recoverable amount, which is 10,000. As simple as that. Okay, sir. Now you answer me. Carrying amount, we got it to be 12,687. Recoverable amount, now we got it to be 10,000. Tell me, is there impairment loss here? In this problem, is there any impairment loss? Do you think impairment loss is there? Yes. Impairment loss will only come under one circumstance I told. What is that? Carrying amount is greater than the recoverable amount. Here, carrying amount is 12,687. Recoverable amount is only 10,000. You can recover only 10,000 from the asset, but you're showing the asset in your books at 12,687. So, asset is overstated. By how much amount? The difference of these two. What is the difference of these two? 12,687 minus 10,000 if you do, it is nothing but your 2,687. That 2,687 ka difference of these two, that itself is what, sir? Impairment loss. That's what they've calculated here. The next. Carrying amount minus recoverable amount if you do, you're getting the impairment loss. People, there is no impairment gain. There is only impairment loss. Okay, if you want to book a gain, you'll have to do revaluation. So do revaluation model. So there is no impairment gain concept. There is only impairment loss. So that is your next working. Everybody good? All okay? Okay. All right, fine people. Now impairment loss ka journal entry also I had told. Anybody remembers that? 1 minute. I'll just check. There's something wrong with the pen. No. Maybe. I think I'll have to. 1 second. Maybe I have to stick to this. No, this is also not good. I have to stick to this only or this only. Now it's writing better. Now it's better. Maybe I'll try this. This is better. Everybody good. Okay people. Sir, I had told you impairment loss ka journal entry is as simple as same as your depreciation ka entry. So what is the journal entry you will pass for impairment loss, people? Simple. So the journal entry will be impairment loss account debit. Impairment loss going forward, I'll refer it to as IL. Okay. Impairment loss account debit 2687. Okay. What is the concept of impairment loss? The reason why impairment loss has come is asset is overstated. So we want to decrease the value of the asset. That is the very intention of impairment loss. Yes. So that means you will credit PPE account. So impairment loss ka journal entry is nothing but your impairment loss account debit to PPE account or whichever asset is getting impaired. That is it. Same like depreciation. Okay, sir. Usually, I'm using the word usually because there is another treatment for it. Usually impairment loss will be transferred to SPL. So the transfer entry will be SPL account debit to impairment loss. Usually. There is one more circumstance which I will tell you as a concept. This is the entry. Clear, sir? That's a journal entry for impairment loss. Okay. Now you tell me, due to impairment loss, you're crediting PP. Due to impairment loss, you're crediting PP. The moment you credit PP, carrying amount will be same or it will get revised. Just like revaluation, after you do revaluation, carrying amount will get revised. No? Just like that, after impairment also, carrying amount will get revised because you're crediting PP. So what will be the revised carrying amount? The revised carrying amount of PP is before impairment loss. Before impairment loss, the carrying amount was 12,687 here, right? Before impairment loss, the carrying amount was 12,687. Now, how much did you credit PP by? You booked an impairment loss of 2,687 here, right? So, hence, PP ka carrying amount will reduce by 2,687. So, how much it will become? It will become 10,000 rupees. So, 10,000 rupees will become your revised carrying amount. That's what they've written here. So, after impairment loss, carrying amount will reduce. And it will become, what is that 10,000? That 10,000 is nothing but your recoverable amount. So after impairment loss, the carrying amount and recoverable amount will become same. That's all. Easy. Okay. One more concept. What is that? Sir, the moment carrying amount gets revised, original depreciation, here you've been calculating this depreciation, henceforth, so this is for the first 3 years depreciation. So impairment came on the last day of current year, no? Third year ending impairment indicator came. Okay. So third year ka depreciation already accounted. So third year ending carrying amount got revised. Third year, dates are important. Yeah. Third year ending carrying amount gets revised. Right. Third year ka closing balance will become fourth year ka opening balance. But from year 4 onwards, do you think this depreciation will hold good or we have to recalculate? We have to recalculate, because the moment carrying amount gets revised, we have to recalculate the depreciation. So if you want to calculate the revised depreciation, what will be the revised depreciation? The revised depreciation basically will be the revised carrying amount. How much is the revised carrying amount? 10,000 minus residual value. There is no change in residual value. Residual value is still 500 divided by life. When you bought the asset, life was 8 years, but 3 years is already over. So the remaining life is 5 years. So 10,900 minus 500 divided by 5. That's what they've done over here. So you'll get the depreciation to be 1,900 from year 4 onwards. That's what I've written here. From year 4 onwards or next year onwards, the depreciation will be 1,900 every year. That's all. The simple basic question which will kind of cover the overall concept of impairment loss. With that in mind, I made this question as LDR. If you are okay, then I'll move on to the next. No problem with question number 1, no? Can I move on? Done. Okay, the next one is, so people, when I passed this journal entry, I told impairment loss usually goes off to SPL. I did not use the word impairment loss goes to SPL. I said impairment loss usually goes to SPL. Why did I use the word usually? Because there are 2 treatments for transfer of impairment loss. This entry is same, right? First entry will come in every circumstance. Okay, same. This is okay. Second entry, impairment loss may be transferred to SPL or it may be transferred to something else also. Would you like to take a guess? You know this. You know this. Can you take a guess without looking at your book? Instead of adjusting or transferring impairment loss with SPL, it can also be adjusted with some other reserve. We have done this reserve. Ind AS 16 mein, Ind AS 38 mein. OCI we used to call this reserve as OCI. What is this now? What sort of a reserve is this? Perfect. It is revaluation reserve, RR. So listen to this carefully. If an asset was revalued before, not any asset, if the asset that got impaired, let's say this is building, let's say this 2687 is a building assumption. So the asset which has got impaired, that is in my example building, if the same building was revalued before, not any other building, not any other asset, if the same building, same asset, if it was revalued before and if RR exists on the same asset, then instead of transferring impairment loss with SPL, it can be adjusted with RR. So first priority of impairment loss adjustment is to adjust with RR. So if you have revaluation reserve, because revaluation reserve cannot be utilized for many purposes, right? So because SPL and all is a free reserve, you can use it for any purpose, right? So hence, if impairment loss comes, first you try to adjust with RR. If RR balance exists, first try to adjust with RR. Okay. If RR balance is not there or if there is shortage, then you try to adjust with SPL. That's all. That all are done. Great. All of you are saying RR. That's awesome. Clear? Just to give you a number example here. Let's say impairment loss is 10 lakh. Impairment loss is 10 lakh. But we have impairment loss is 10 lakh. Let's say we have RR only 9 lakh. So what you will do? Tell me the entry. Let's see. If this is the case, what is the journal entry? Impairment loss, I've assumed 10 lakh. Okay. RR, I've assumed it to be 9 lakh. If this number comes into picture, what do you think will be the journal entry that we'll pass? First journal entry is same. What is that? Impairment loss account debit to PP. The first journal entry is same. No change there. What about the second journal entry? Will you transfer this impairment loss to SPL now? No. First you'll try to adjust with RR. But impairment loss is 10 lakh. RR is only 9 lakh. So the entry you'll pass is what? Since only 9 lakh balance is there in RR, first you'll write RR account debit. RR account debit. How much? 9 lakh. Then what? You'll have to credit impairment loss to the extent of 10 lakh because that's the impairment loss. So balancing figure, we don't have enough balance in RR. There is a shortage. For shortage, we will use SPL. So the journal entry will be RR account debit 9 lakh, SPL account debit 1 lakh to impairment loss account 10 lakh in my exam. That's it. This is the funda of impairment loss ka transfer. First entry will be same people. There's no drama there. First entry for impairment loss is impairment loss to PP. Only the transfer entry. Impairment loss may be adjusted with RR if RR exists. Otherwise, if RR is not there, if RR is there in the question, they will mention. If they don't give RR balance, that means we don't have RR. If RR is not there or if there is any shortage in RR, then we'll transfer it to SPL. That's what I've tried to summarize. That's what they've given you here, all these people. All that story is that only. No need for all that story. Whatever point I've written here, these two, that's good enough. Okay. Yeah. Question number 2 is a homework. Yeah, but don't do it now. Do it after Ind AS 12 or after Ind AS 103. Once I do Ind AS 103, then if you want, you can solve this question number 2 or you cut it off because similar questions you will find it there also. So, but now don't try to solve this. Only after Ind AS 103. So that's homework. So moving on to the next 2. Now one small concept is there. Then the remaining questions I think will come around that concept. So let's probably review this. Now people, you answer me. How do you get recoverable amount? How do you get RA? Value in use, VIU, or fair value less cost of disposal or cost to sell, whichever is higher. Correct? So if we compare these two and take the higher of the amount to be recoverable amount. Yes, G. Now I want you to focus on VIU. VIU ka full form is value in use. What does it mean? Value in use means by using the asset, how much benefit you will get. Correct? Can I say that? Value in use is nothing but by using, how much is the benefit. That benefit we try to get it on present value platform. And that present value of that future benefit only we call it as value in use. In simple terminology, that is value in use. Correct? Now, you think ArivuPro, think from coaching's perspective, our coaching academy perspective. I have an iPad. Or let's say I have a furniture, right? What is the benefit of that furniture alone? We have various assets, right? We have television, we have iPads, we have MacBooks, we have furniture, we have sofa, right? So, okay, let's take this. We have sofa, right? What is only sofa ka benefit? Can you tell? Can we estimate that? Sofa ka benefit. From sofa, how much future benefit we'll get? Is it possible to estimate that? No, because the benefit for the academy is what, people? The money that we collect from coaching, correct? No, the fees that you pay to us. That's the benefit basically, correct? But in order to get the fees, we need to conduct the class. And to conduct the class, we need assets, right? So yes, so your coaching fees is the benefit that we are getting for the investment that we have made in assets, correct? But we have not invested in one asset. And to do the classes, to conduct the classes, we are not using only furniture. We are not using only bench. We have to use camera also, mic also, iPad also, laptop also, AC also, TV also, sofa also, everything. Everything put together generates the benefits for academy, correct? That means individual asset ka benefit, I'm not able to find out, correct? So if sofa by chance gets damaged, if there is a physical damage caused to the sofa, that's an internal impairment indicator. Whenever indicator comes, we need to do the impairment check. To do the impairment check, we need recoverable amount. To find recoverable amount, we need value in use. But this sofa does not generate independent benefits because many assets put together. For an academy, all these assets, AC, TV, furniture, put together, we get the benefits. Individually, with sofa alone, we can't get the benefits. We don't get coaching fees. Only from sofa, yes or no? That means, how do we find out value in use? Because indicator has come. We can't skip it. But we are not able to find out the benefit of sofa alone. Getting the problem? So like this, many companies will have individual assets. Many companies will have individual assets. They don't generate benefits alone. Many assets put together, when they come together, you will get the benefits. But they will never generate an independent benefits. From the sofa alone, what is a benefit? You will not be able to estimate it because it does not generate independent benefits. By selling sofa, how much money you will get, I'll be able to tell. Fair value less cost to sell, I can find out. Because fair value means by selling how much money you'll get. I can find out that. But value in use means by using how much benefit. It does not generate independent benefit. So how do I find value in use? Because without value in use, I cannot find out recoverable amount. Without recoverable amount, I can't do the impairment check. Got the pain point over here? Got the drama? Now to sort out, and we'll not have one assets like this. We will have many assets which will not give individual benefits. So finding VIU for that asset is really a challenge because it does not have value in use. So how do we do the impairment check for such assets? Was a question raised. For this, they introduced a small concept called CGU. What? CGU, cash generating unit. Cash generating unit. Cash generating unit. For class purpose, we'll call it, there's an acceptable short form. We call it as CGU, cash generating unit. Okay. Now, what is this cash generating unit? CGU means, listen to this, smallest group of, not individuals, smallest group of individual assets which generates independent cash flows. Once again, CGU means smallest group of identifiable assets or individual assets which can generate independent cash flows. Indirectly, what we are trying to say. Now, this furniture, in my example, sofa set will not give you individual benefits for ArivuPro. We will get benefit when we use multiple assets together. Yes, that sofa, mic, camera, laptop, iPads, AC, all this put together, we can conduct coaching. Yes or no? So that means benefit you are getting not from the individual asset, but from a group of asset level. That group you need to identify. Now, which group? Individually it is not getting benefits? No problem. Group level, is it getting benefit? Yes. So which group generates independent benefits? Find out that. And it's not the largest group. It is the smallest group. Like if you just check ArivuPro, we have Bangalore branch, we have Chennai branch also, right? In Bangalore also we have multiple locations, correct? Now, let's say in Bengaluru, we have Koramangala branch and we have Malleshwaram branch. In Koramangala also, we have iPad, furniture, sofa and all. Malleshwaram also we have. So, should we combine Malleshwaram ka and Koramangala branch ka all the assets together and call it as group? Not required. Malleshwaram assets are enough for us to generate benefits. Yes, no? Using Malleshwaram assets, Malleshwaram sofa, etc., 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 we can conduct coaching and get benefits. So, that becomes one group. Koramangala mein whatever assets we have, those group of assets, they are generating independent benefits. So they become one. That means in my example, there are Malleshwaram group of assets become CGU1. They become CGU1. Koramangala branch ka asset becomes CGU2. Because that's what a CGU means. CGU means not individual asset, but a group level. Basically, now we are not doing the impairment check at individual level. If you cannot do impairment check at individual level, do it at group level. That group of asset only, we call it as CGU, cash generating unit. And keep in mind, it should be the smallest group, not the largest group. So that's the reason Malleshwaram is a separate CGU, Koramangala is a separate CGU because of the smallest group. And also keyword there is, it should generate independent cash flow. Between the CGU, there should not be any interdependency. If they are interdependent, then they are not separate CGU, they become one CGU. If there is any interdependency or codependency, then they are not separate CGU, they become one. Okay, these are the keywords for CGU. Okay, what is it? CGU means basically group of assets. It should be the smallest group of identifiable asset, but it should be able to, that group should be able to generate the benefits independently on their own. Okay, that's it. That group you need to find out, and that becomes a CGU. And at this group level, now we'll do the impairment check. Impairment check activity is the same now. Same. To do the impairment check, we need two components. What is that? Carrying amount, recoverable amount. But now we will find carrying amount of CGU. Find out carrying amount of the group. Find out recoverable amount of the group. If carrying amount of the group is greater than recoverable amount of the group, then you will get impairment loss relating to the group. This will not be impairment loss relating to individual asset. It will be impairment loss of the group. That group only we are calling it as CGU. Got it? This group level ka impairment loss. Group means there are multiple assets, no? So this group ka impairment loss will be allocated to the individual assets in the group. First, find out impairment loss of the group and then do the allocation. Allocation, I'll tell you with this particular example. Don't worry about that. But theoretically, it makes sense now. What we said. Is there any doubts you have here or okay till here? How to allocate, how to calculate, I'll take you through a small example. But theoretically, is this fine? Sir, even if one asset in the group is impaired, should we check the impairment for all the assets in the group? No, sir. Should we check? Yes. Should we check? Yes. Should we book? No. Are you getting the difference between these two, Harihara? What I'm trying to say? You asked, if one asset in the group, is it impaired? Should we do the impairment check? We should do the impairment check because it's an indicator, right? But it's not necessary to book impairment loss. Why is it not necessary? Just because one asset has got physically damaged, other assets are functioning well, no? So impairment loss only will come if carrying amount, if it is greater than recoverable amount. Just because one asset is physically damaged doesn't mean that carrying amount of the group will be greater than recoverable amount. Carrying amount of the group may be still lesser than recoverable amount. Only if this is greater, we will book impairment loss at group level. If it is lesser, we will not book impairment loss. So to answer your question, we will do the impairment check, but we may or may not book impairment loss. That's a good question. Okay, G. So that means, okay, I'm thinking others, no comments. I'm thinking you guys are good. So let's understand this with the help of a small example. All this will come as a question, but I just don't want to leave it at theory level. Let's look at a small example, chain to pin to example I've constructed here. Check. Now, people, a company has plant and machinery, land and building, furniture. These, I've assumed they have these three assets and their carrying amount is this. These three assets don't generate independent benefits. These three assets do not generate independent benefits. On their own, they do not get the benefits. So what to do? On their individually, if they don't generate the benefits. So individually, if they are generating the benefits means you do the impairment check individually. Okay. If they are not generating the benefits individually, if you are not able to find out the benefits relating to these assets individually, then you do the impairment check at group level. Since they do not generate the benefits on their own, let's say when all these three assets come together, then only you will get the benefits. Like factory. In order to produce the goods in a factory, you need machinery also, you need that factory building also, and maybe some furniture also. Correct? So all these three, when they come together, they generate the benefits. Individually, they do not generate the benefits. That's an assumption or example I'm taking over here. Okay. That means now you'll have to do the impairment check for these assets at what level? CGU level. So if you're doing the impairment check at group level or CGU level, what are the things we need? We need carrying amount of CGU. Add the carrying amount of individual asset. You will get group ka carrying amount. 5 plus 3 plus 2. 10 lakh is carrying amount of CGU. Recoverable amount of CGU, they will be giving it to you in the questions in these sort of cases. I've assumed that to be 8 lakh. Just an assumption. Carrying amount is 10 lakh of the group. Recoverable amount of the group, I've assumed it to be 8 lakh. Now tell me, is there any impairment loss here? In this case, is there any impairment loss? Yes. How much? Carrying amount is greater than recoverable amount. By how much? 2 lakh. So you will book 2 lakh as the impairment loss. For which asset? This 2 lakh is the impairment loss, not for any specific asset. This is the impairment loss of the group. So CGU ka impairment loss is 2 lakh. Since you are taking group ka carrying amount and comparing with group ka recoverable amount, the impairment loss that you get is also relating to the group. So CGU ka impairment loss is 2 lakh. Okay, sir. Now this is group ka impairment loss, and this impairment loss now you'll have to allocate to group ka assets. We have 3 assets. So this 2 lakh ka impairment loss you allocate to group ka assets. In what ratio? Obviously carrying amount ratio. So this 2 lakh ka impairment loss will be allocated to the individual assets of the group in their carrying amount ratio. Carrying amount is 5 lakh, 3 lakh, 2 lakh, or 5:3:2. That's all you'll have to do. This 2 lakh impairment loss in carrying amount ratio, you apportion. Got it? So if you do the apportionment, I've done it over here. What will be the impairment loss? 2 lakh in 5:3:2 ratio if you do it. For towards plant and machinery, 1 lakh impairment loss you'll allocate. Towards a second asset, that is building, you'll allocate 60,000. Furniture, 40,000. That's all. And we already know when you book impairment loss, carrying amount will be same or it will reduce. The moment you book an impairment loss relating to an asset, that asset ka carrying amount will reduce. So the revised carrying amount will be what? Before impairment loss, carrying amount of plant and machinery was 5 lakh. How much impairment loss did you allocate? 1 lakh. So the revised carrying amount will be 4 lakh. 5 lakh minus 1 lakh, 4 lakh. That's what I've done it for other assets. Take the carrying amount and reduce the respective impairment loss. You'll get the revised carrying amount. This is the allocation rule. There are some 1 or 2, don't copy all this. There's some 2-3 extra steps that will come here. Maybe I'll do that tomorrow or if time permits today, right? We don't do this alone. There are some extra fittings also, but I just wanted you to be aware at group level, how do we generally book? So no need to copy this example. We have like at least 5-6 questions on this only. So just listening is good enough. So understanding wise, are we fine? Group ka impairment loss, how to book? Totally comfortable? Can I move on to the next one? Okay, then I'll move on to the next people. Next we have a small case study questions. Identification of CGU. To find out how many CGUs we have a couple of questions. You do that. I think the same question you'll find it in your CA intermediate book also. Same are there. We have done it in CA intermediate also. But anyways, we'll quickly do a few of them. Okay. So third question in our notebook is a third question we are doing in our class also. We are doing in that order. A mining entity, a mine, a coal mine or a gold mine or whatever entity, they own a private railway. Private railway they own. Okay, that means they have control over it. It's a separate asset. If you don't have control over it, then it is not a separate PP. We've done this question. Remember in that PP question we saw railway siding wala thing. So here they're saying entity owns a private railway. So they own it means they have control over it. So it's a PP, separate PP. So they own this private railway for their mining activities. So when you mine and all, lot of dust too and a lot of main finished product also gets extracted, no? So they feel it's easy to transport all that with the help of a railway. So they have their own private railway, which they're using it for mining activities. Fair enough. This private railway, okay, this private railway, that is PP, could be only sold for scrap value. If you want to sell it to some person, they'll only buy it for scrap value. Maybe it's a very small private railway and in a remote area. So probably for others, there is not much usage. So if you want to go and sell it, you'll get very, very minimal value, scrap value. And it does not generate. It generates, they use the word, it does not generate cash inflows that are largely independent of cash inflows from the other assets of the mine. That means from this railway mine, does this railway generate independent benefits or it does not? It does not generate independent benefit is what they're trying to say. Now you tell me, sir, what is this? Is this, they're trying to ask, is this railway a separate CGU? Can you treat a railway line as a separate CGU or you cannot? No, since it is not generating independent assets, or maybe to rephrase this question, can you do the impairment check on railway on an individual basis? Can you try to do the impairment check on a railways individually? No. Why? Because it does not generate independent benefits. So you'll have to do the impairment check at CGU level. So how many CGUs are there over here? We have one CGU. What is it? Whole mine. Mine as a whole generates the benefits. Correct or no? Correct. So this railway line does not generate independent benefits. So that whole mine becomes one CGU. That's what they've written as a final answer. So that whole mine becomes one CGU. Okay, the mine may have many assets. Like railway is one asset. You could have many other machineries also like this. So that whole group, that mine itself becomes one cash generating units over here. That's all is a question over here. Identifications of CGU. Done. Okay. Question number 4. Look at this. A bus company provides service under contract with a municipality, some government body, that requires minimum service on 5 separate routes. Now, obviously, if you have a city like Chennai or Bangalore, right, the buses will run, right, connecting one part of the city with other, like Majestic, Koramangala, and HSR in Bengaluru, T Nagar, Nungambakam, etc., in Chennai. So the government body has has told us that 5 separate routes may I want you to deploy the bus. So basically they outsourced this bus flying contract to us. Maybe we own a lot of buses. So we have made a contract with the government saying we will run the bus in 5 different routes. Fine. All right. The assets devoted to each route and cash flow from each route can be identified separately. Okay. So let's say Koramangala to HSR. That is one route. So from that route, how much cash flow this company will get? In that particular route, this bus company will deploy one bus. Let's say one bus runs in that area. When a bus is running in, from the passengers, we collect a ticket. No, we sell the tickets and get the revenue, right? Right? So they're saying that you can identify separately. So each route ka, how much cash flow each route will generate, you can identify separately. Okay? One of the routes operating at a significant loss. One route you're making a heavy loss because there are not much passengers in that route, so we're making a loss. Now the question to you is, don't look at the solution. How many CGUs are there in this? 5 CGU. Because each route generates independent cash flow, and in each route you may have 10 buses, 15 bus or 1 bus. Yes, possible. Correct. So here we have each route is a separate CGU. Meaning, do we have 5 CGU or 1 CGU? Can you answer me this question? Here, we have 5 cash generating unit or 1 cash generating unit. 5 or 1? What do you think? When I read this question, what are your feelers? Quickly answer, let's see. 5 or 1 or something else only. You guys are creative. You might bring in your own things. So tell me. Let's see. Let me hear some answers from you. Jayant Kaikani is saying, oh, 5 CGU, sir. I say pi. What about others? What are your pillars? You are feeling you need a break. I will give you break. But before that, answer this question. 5 or 1? So don't know, sir. You tell, sir. Okay, 1 minute. Some more answer I've got to. Okay, Harihara is saying, sir, 1 CGU, sir. 1 CGU. Why, macha? Any specific reason? Even Jayant also. Why do you think 5 and why do you think 1? Any justification you have? Harihara, you said 1. Any specific reason you're saying 1? I'll tell you. You are right. Answer is 1. Right? Perfect. Yes, perfect. Same questions are there in our CA intermediate also. Correct. Right? Yes, people. Though you are able to identify cash flow from 5 routes separately. Each route ka cash flow you can find out. Correct? But I told you the key term in CGU. What is that key term? When I did discuss the CGU, I read the definition. CGU is the smallest group. Correct? Of identifiable assets. That is one keyword. Smallest group. Second keyword was what? Independent cash flows. Independent cash flows. That's what I said. Correct? Here, the keyword there is minimum service. We have to give minimum service in all the 5 routes. One route is operating at a loss, no? So if bus company says, since that route is operating at a loss, if they stop deploying bus in that route, if they stop giving service in that loss wala route, what will happen to other 4 routes? If one route, since it is operating at a loss, if bus company stops deploying bus, if they don't run bus in that route, what will happen to other 4 routes? The government will allow you to run the contract, or they will allow you to run the buses in other 4 routes, or other 4 routes also will get cancelled. Other 4 routes also will get cancelled because you have to give a minimum service. Meaning minimum service could be, let's say you have to run, government is saying you have to run 8 hours a day. Bus should run in this route for minimum 8 hours in a day. I'm just 8 hours they have not mentioned. I'm just telling you for an example's sake. Okay. So if you don't run the bus for minimum 8 hours, what will happen? The entire 5 routes ka contract will get cancelled. That means all these are independent or still interdependent? Interdependent. For it to be a CGU, you have to generate, you not only have to generate benefits, but that benefit has to be on an independent basis. But here they use the word minimum service. So hence the routes are interconnected. Routes are interdependent because if one route ka contract, if one route gets cancelled, means all the other 4 routes also will get cancelled. So that way they are independent, or that way rather they are dependent on each other or interdependent. So it is not 5 cash generating unit, it is 1 CGU. Meaning, but the whole bus company is 1 CGU. That's all they're trying to say. Now better. Everybody understood? All these are 1 or 2 marks. The keyword there is minimum, people. On this, we are basing our answer. Fair enough. So let's move on. No comments. So thinking move on. Okay, next to 1 minute. After this question, see like this, I've given the numbering. After fourth question, our fifth question will be question number 9. So come to question number 9. In that order, we will cover. Question number 9. Okay, here, question number 9. So let's see. Again, this is CGU identification wala question. So let's see if you can identify this better. A significant raw material is used for plant Y ka final production is intermediate product bought from plant X of the same entity. So we have two factories or plants, whatever you want to call it, plant X or plant Y. So what they're trying to say is significant raw material which is used by plant Y is an intermediate product produced from plant X. Plant X will produce a product. Plant X will produce a product. That product is sold to plant Y. Whatever finished goods plant X produces, that finished goods becomes raw material for plant Y ka activity. That's what they're trying to say. So here raw material, this company is not purchasing from a creditor. Raw material also they are manufacturing, and using that raw material, they're producing a finished product. To produce raw material, they have a plant X. And plant X will sell that raw material produced to plant Y, and plant Y will use this raw material for their further final production. That's what they're trying to say. Okay. All right. X products are sold to Y. Plant X sells their product to plant Y at a transfer price that passes all the margin to X. Fair enough. They have some transfer pricing arrangement. They have a specific price at which X will sell it to Y. Great. Excuse me. 80% of Y ka final product is sold to customers outside the entity. So whatever product plant Y produces, 80% is sold to outsiders. Maybe 20% is sold within the entity. Maybe we have some other plant also. It is sold to that. 20% to which plant it is sold, not mentioned. It's fine, no issues. That's the order. This is plant Y ka data. What about plant X? They've given two cases. For each of the following cases, what are the cash generating units? So basically their question is plant X and plant Y separate CGU? Or are they one CGU? Because plant means you'll have many assets, no? Building also, you'll have machinery also, you'll have furniture also, you'll have. So, is this a separate CGU? Is this a separate CGU? We have two CGUs or one CGU, you need to answer there under two circumstances. One, check this line. If X could sell the product it sells to Y in an active market and internal transfer price are also higher than market prices, what are CGUs for X and Y? Now, currently what is happening is, in fact, we didn't read this line, 60% of X ka final production is sold to Y. Balance 40% is sold to outside the entity. So, whatever plant X produces, 60% of that final product, X is producing raw material, at 60% of that production is sold by plant X to plant Y, 40% we sell it to the outside entities. This data is also given. Okay. Now, in first case, they're saying, currently, X is selling 60% of its produce to plant Y, no? Right? If X wants, they can sell this product instead of selling the 60% of the product to Y, they can sell it to the outsiders in the market also. So X is not really dependent. Currently, X is selling 60% of the production to Y. Instead of selling this to Y, they can also sell it to the outsiders in the market also. There is enough demand for it, is what they're trying to say. In this case, what to do? Use your common sense. Sir, if X can sell the 60% of the product to outsiders, that means Y can also buy it from an outsider. If X can sell this product to a third party outside the entity, that means Y also can buy it. That means, do you think these two are really independent or they can operate independently? They can operate independently because there is no dependency. X can also, if X wants, they can also sell it. This currently, instead of selling it to Y, they can sell it to anybody else. If X can sell it to anybody else, Y also can buy from anybody else. So there is no dependency in this case. That means what? They can function independently. Currently, X is selling 60% to Y, but if this transaction breaks also, if this contract, if this stops also, plant X and plant Y both can function on their own. That means they can generate independent benefits on their own. That means plant X is a separate CGU, Y also becomes a separate CGU. So we have two CGUs over here. That's a final answer. That's what I've written here. If X can sell the product to others, then Y can also purchase that product from others. So they can function independently. So they are separate CGUs. This is the answer to the first case. Okay. What about the second case? Check. If there is no active market for product X which sells to Y, what are CGUs? So there is no active market. So currently X is selling 60% of the product to Y, no? Correct? Now they are saying there is no active market. Whatever product X is producing, there is no active market means X cannot sell it outside the entity because there is no active market for it. That means whatever X produces, it has to sell it to Y only because nobody else in the market will buy it. That's what they're telling in the second case because there is no active market for it. That means what? X is completely dependent on Y. So if X cannot sell their product to outsiders, that means Y has to buy this product from X only because this product is not available. Correct? So that means there is a dependency between X and Y here. If X cannot sell this product, if X can sell this product only to Y and not to anybody else, and then there is a clear dependency among these two. That means they can function independently. No. If X shuts down means Y also probably will shut down because there is a codependency. So in this case, they're not functioning independently. They're dependent on each other. So there are, in second case, it will be one in CG. X and Y both become one cash generating unit in this particular case. Yes, sir. That's all is the answer. Balance is a story. You don't have to worry about story. Final answer is good enough. All this will come for 1 or 2 marks at best. Okay. So next is question number 6. That is question number 18. Question number 18 becomes question number 6 for us. Come to question number 18. Mark it so that you'll know how to, like, in which order we need to present it. People, I'll do this question and I'll give you a break. Would you be comfortable with that? Another maybe like 10 minutes. Okay. Manageable. Already reached Buddha zone, or can I push for one more question? 10 minutes. Comfortable? Or you already taken a break without telling me? You tell me also and take break. We both will take together. Okay. We are one CGU. Done. Okay, maybe like I'll just do this question and give you a break. Remember, I asked you to remind me about one concept that were previously foreign cash flow, something we saw. All right. So this is the question on that. I'll just go back to that concept and then come back to this question. I think in the second page or third page it was there. Excuse me. Where is it? It's there in page number 5.2. Okay. What is this concept is? What if the cash flows are in foreign currency? Because there could be a case where we have a machinery, right? From that machinery, we are producing a product, and that product is, we don't sell it locally, it is 100% exported. Possible, right? From a machinery, we are producing a product, and that product we never sell it in India, in local market. We always export it to some foreign countries. When you export it, let's say to US, that means all the benefit you will get it in dollars. So that's what we mean by that. What if all the benefits, all the cash flows that you are getting from a specific asset, it could be individual asset or CGU, does not matter, right? But what if the cash flows are in foreign currency? It's not in INR, but in a foreign currency, a dollar, pound or yen or whatever. In that case, know what to do. Then how do you do the impairment check? That is what this concept is all about. Okay, fair enough. Now people, fair value less cost to sell is not a drama, because if benefit you may get it in dollars, but machinery, if you want to sell it, you will sell it in India only, no? So fair value less cost to sell will be in INR, so that there is no drama. But from that machinery, you are getting a product which is sold and which is exported to US, means the benefit will be in dollars. So this will be mostly relevant for your value in use. Okay. What if your cash flows are in foreign currency, any foreign currency? So how do we find value in use? First, very simple. Since the cash flows are in foreign currency, first to find value in use in foreign currency itself. Find out VIU not in Indian currency, but in that foreign currency itself. First step. How do you find out value in use? They will give you future cash flows. Take the future cash flows that is given in foreign currency and multiply by the discount factor. This cash flows will be future cash flows. So multiply by the discount factor. But keep in mind, this cash flow also will be in foreign currency. So whatever is the discount factor relating to this foreign currency, pick it up. Here they will play around. They will give you discount factor relating to Indian currency also. They will give you discount factor relating to dollar also. You will take dollar related foreign currency. Since cash flow is in dollars, the discount factor, you will take it relevant for the dollars. It will be given to you in the question. We'll see this in the very next question. Okay. For that foreign currency, whatever is the discount factor, take that. So this is your future cash flows. This is your discount factor. Multiply and you will get what? The present value. That present value of future cash flows only, we call it as value in use. Since both these are expressed in foreign currency terminology, this value in use also will be in foreign currency. First find out this normal way. The way you used to find out value in use in Indian currency, same step, first you do it in foreign currency. Then from value in use in foreign currency, convert it into value in use in Indian currency. From foreign currency value in use, convert it into value in use in Indian currency. How? Multiply the exchange rate. They would have given exchange rate. $1 is equal to 90 rupees, 100 rupees. They would have given. So use that and convert it into Indian currency. Okay. Sir, which day ka exchange rate we should use? Exchange rate will fluctuate daily. So which day ka exchange rate to use? On whichever day you are finding value in use. On whatever day you need a value in use. That day ka exchange rate you'll have to use to convert it, which will be provided to you in the question. Okay. That's what I've written here. Convert value in use into Indian currency INR using the exchange rate on the day value in use is calculated. Okay. That's pretty much what we have to do here. Simple one. Okay. So let's apply it in one question. Okay, come to that question. Maybe you'll understand it numerically a little better. Easy only. What was that question? I think it was, 1 second, let me try to find it. Where it went? Now here, question number 18. Easy question, check this. On 31st March 20x1, company makes the following estimate of the one of its asset located in USA. So they have asset only in USA because we could have some foreign branch also, no? Right? So that asset itself is located in US. So if it is located in US, obviously benefit will be in dollars. Okay. So they have given this. See, we are on what day? 31st March 20x1. Here they have given the benefit on x1, x2. That means next year. x2, x3, x3, x4. How many years? 3 years. Next 3 years ka they have given the future cash flows. So obviously this is future cash flows, but not in Indian currency, but in dollars. What is that? Now check. They have given discount rate. They have given India related discount factor 15%, US related discount factor 10%. What will you take for calculation? 15 or 10? Since the cash flow is in dollars, you will take discount factor also related to dollars. This is your future cash flows and this is your discount factor. So take 10% off. Okay, sir. Everybody good? First, let's do this calculation. Then I'll read the remaining part. Okay. This is your future cash flows and 10% is the discount factor relating to the US dollars. So that's what I've done it here. Take future cash flows. 10% is a dollar related discount factor. Take it. At 10% discount factor, find out the PVIF each year ka. Since the cash flow is different every year, you can't do shortcut. We have to take each year ka discount factor separately. That only we call it as PVIF, present value interest factor. Future cash flows, discount factor. Multiply, you will get the present value. The total present value itself is value in use. But this value in use is in dollars because all the data is in dollars. Now from dollar, you need to convert it into INR. For that, we need exchange rate. Which exchange rate to use? Okay, on which day you need value in use? First figure out that. On what day are you trying to find out value in use? Sir, you are estimating the future cash flows on 31st March 20x1. Estimation of future cash flows only is required to find value in use. And you will find value in use only when the impairment indicator has come. Correct? So basically, impairment indicator has come on 31st March 20x1. Hence, you are estimating the future cash flows. So this is the date on which we need to find value in use. 31st March 20x1. So this day ka exchange rate we need to use. Is it being given? Yes. 31st March 20x1 ka exchange rate is $1 is 45 rupees. Probably they are in long ago. Now I think it's almost touching 9500 also, I think almost. Huh? Then 31st March 20x2 ka, x3 ka, x4 ka, they've given the exchange rate. We don't need all of this. We are trying to find value in use on 31st March 20x1. And on 31st March 20x1, $1 is 45. So exchange rate we will use is 45. So use that. $1 is equal to 45 rupees. So $170.40 is how much? So multiply these two. If you multiply these two, you will get the value in use in Indian rupees. That's what I've done here. A very simple faltu 2-marker question, in fact. Okay, but still, I think once it has come in one of the attempts. That's it. Now your comments. You want to continue with 1 or 2 more questions, or we'll take a break? Respond. What do you want to do? Break or continue with 1 or 2 questions? Now I need some response from you people. Yes or no would be nice here. Break. Unanimously they're telling break. So okay, fine, all right. Fine, fair enough. So we're done till 6 questions. Fine, people. So let's take. It's almost like 7:45ish. Let's come back by 8. Due to that event that we have in Chennai today, the Vijayam or Jayam, whatever. Right. I may have to wind up the class by maximum 9 or 9:15. So let's reassemble back by 8 o'clock and then try to cover a few more questions. Okay. All right. Come back by sharp 8.